Hello everyone, and I welcome you back to a new session of this channel. Our today's topic is related to types of accounts according to traditional approach, and these types of accounts are as real account, nominal account, and personal account. The real account and nominal account is also called as impersonal accounts. Why? Because they are not related to a real person or artificial person. And this personal accounts are included to a real person like me and you, or artificial person like a bank, like any another financial institution, because earlier we said that a business entity is a separate entity in books of accounts, in the eyes of accounts. The real account is related to assets and properties, and these real accounts are subdivided into tangible real accounts and intangible real accounts. The tangible real accounts have physical existence and can be touched. The example of tangible real accounts are buildings, cash, stationery, inventory, and etc. All the assets we can see, we can touch, and we can feel. Those are examined by our senses. Hence, those are tangible real accounts. The intangible real accounts, they do not have any physical existence and cannot be touched. The examples could be like goodwill, patent, copyright, trademarks, and etc. But these can be measured in the terms of money and value. We see in the market like KFC's, McDonald's, they are a branded company. Their copyrights, patents, or goodwill are very high in the terms of money. They cannot be touched, but they can be evaluated in the terms of money. They can be measured in the terms of money. If you want to bring a franchisee of McDonald's or KFC's in your country, you have to pay them lots of money because they are branded and they have value, and their value would be measured in the terms of money. As we saw, real account was related to things, but nominal account is mostly related to services. These accounts types are related to income or gains and expenses or losses. For example, rent, commission received, salary, wages, conveyance. Suppose we received rent. Here, the rent is received. That is why it is an income. And if we paid rent, that would be as an expense. Suppose we found a mobile phone, that would be a gain. And suppose we lost a machinery by firing, then it would be a loss. This is a service we are receiving or we are giving to others. As the name suggests, personal accounts are related to people, to a person. But in the eyes of accounts, these persons are not only real persons. It could be artificial persons. The real persons could be Tom's account, Sarah's account, John's account, any name here could be. But the artificial persons who are included here, this could be a partnership firm, it could be companies, bodies of corporate, and etc. For example, Tom and John Trading Company, charitable trusts, XYZ Bank Limited, or it could be any another company. Here we must understand that personal accounts could be a person or it could be an artificial person like a bank. Still, the traditional approach is the most usable approach in whole world. The beauty of this traditional approach is the opposite of debit is credit. It means if debit says the one way, the credit says the exact opposite way. Here we have some golden rules. We call them as golden rules. These golden rules are As firstly, we are dividing the accounts into three parts, as we said: personal, real, and nominal. The personal account rule is debit the receiver and credit the giver. Further, we will explain it in example. Real account says debit what comes in. What comes in organization, debit it. And what goes out from organization, then credit that one. A nominal account, whatever expenses and losses you have, you debit that expense and loss. And whatever profit, gain, or income you're having, credit that one. That would be easily understandable in an example. For example, purchasing machinery for $1 lakh. First of all, we have to find which accounts are affected. Two accounts are affected. The first, machine account. The second, cash account. What machine account is? It is a real account. Why real account? Because it can be touched, it can be seen, and it can be moved. Hence, it is a real account. There's no doubt. Then we have cash account. So what is a cash account? Cash account is also real because we can touch it, we can see it, and we can move it. That's why the both are real accounts. And what is the rule for real account? What comes in your organization, debit that. Debit what comes in. What comes in? The machine comes in because we purchased the machine. Hence, the machine came in our organization. As machine comes in, hence it should be debited. So when something comes in, something must goes out, because in traditional approach we said the debit is opposite of credit. The credit is opposite of the debit. Hence, for purchasing the machinery, we have to pay some money. We have to pay some money to the person whom we purchased from. When the cash goes out, as cash goes out, hence it should be credited. I think it is very much simple. Another example, furniture sold for $50,000. Again, two accounts are affected. Furniture account, cash account. What is furniture account? You think furniture account is real because it can be touched, seen, and moved. This is real account. And what is again cash account? Cash account is also real because the same properties of real account is here as well. Again, we go for the same rule. What real account says? Debit what comes in. What is coming in our organization? When we sold the furniture, furniture is gone. So when furniture is gone, in opposite of that, cash is coming to our organization. As furniture goes out, hence it should be credited because it goes out from our organization. But what should be as debit? Because cash comes in, we debit the cash in books of accounts. Another example, salary paid $2,000. In our organization, we are having managers and we have to pay them salary. Again, two accounts are affected, salary account and cash account. Here, the salary is paid or received. The salary is paid for managers. We are coming to nominal account because salary account is nominal. And here we see debit all expenses and losses, credit all incomes and gains. Here the salary is expense or income. Salary is expense because we pay to managers. And what is cash? So we found that we have to debit because it is an expense. We debit this. And how about cash? Cash comes in or goes out? Cash goes out because we pay it to managers. So what is the rule of real account? Real account says credit what goes out. Cash is going out, hence we credit this one, CR. We found what is debit, what is credit. As salary payment is an expense, hence it should be debited. As cash goes out, hence it should be credited. Another example, fees received $1,000. We are providing some services to another organization. We are a consultancy, hence the fees is coming from that particular company two accounts are affected, fees account and cash account. Here the fees is received or paid. Fees is received. And what is fees? Fees is a nominal account. Hence, in nominal account, debit what comes, debit is expenses and losses, credit is income and gain. Hence, we credit this one because the fees has been received, credit. About cash, cash comes in or goes out. Cash comes in. And what is the rule for real account? Debit what comes in, credit what goes out. Where what comes in? Here, cash comes in. Hence, we have to debit it. That is super simple. Another example, cash received from Tom. Here again, two accounts are affected, cash account and Tom account. Now, cash received from Tom, it means cash has come in our organization. So cash is real, we go to real. What comes in, what goes out? Debit what comes in, credit what goes out. Cash has come in our organization, hence we debit the cash. Now we are coming to Tom account. Tom is the receiver or giver. Tom is the giver. Here the personal account rule says credit the giver. Hence the credit is CR. Credit is Tom. Another example, machinery sold to Tom. Machinery account is real, Tom account is personal. Machinery sold, hence machinery is gone. And real account says debit what comes in, credit what goes out. Machinery goes out, hence we have to credit this. And who is the receiver? Receiver is Tom. Tom is the receiver of machine. He is the debit because the rule says debit the receiver and credit the giver. Here Tom is the receiver, hence we debit Tom. I hope you've enjoyed from this video, and if it is yes, do not forget to like, share and subscribe the channel. Take care and bye bye.